Portfolio Builder members, welcome to our Thursday trade alert where we play the bond market. Trump is having an absolute fit about the high interest rates America has to pay to finance its debt, while places like Germany are actually going into negative territory. They just had a 30-year bond treasury with a negative yield. That means you have to pay money for the right to loan money to Germany. It's absolute insanity, and now there's $16 trillion of negative debt. This has been one of the easier markets to predict and has performed very well. If we zoom in on our returns, we can see that in general, this has been a very smooth sailing portfolio. Not getting rich, but it has done its job to generate consistent profits. 2.2% in December, 0.8% in January. Our only loss, surprisingly, in February when the Fed went very dovish, negative 0.8%. March, we had the best return of 3%, 0.5% in April, 1.7% in May, 1% in June and July and August. Now, today's trade actually came off with a small loss of 87 cents. And that's after making $1.81 week over week. And to summarize what happened, the TLT from placing the trade went from a price of 146.42 and closed out today at 144.28. So we lost $2.14 on the TLT. Our option caller did its job to reduce and minimize potential losses. So we took in a 68-cent credit last Thursday by selling a call option and then reinvesting some of that profit into a put, and we were able to get out of it for an additional 79 cents today, so that's a profit of $1.47. NEM is a large gold mining company that we had a call option on, and we've been doing very well playing the gold market on our Thursday plays with options. Today we had a small loss. We paid 36 cents for that call option, which was part of the profit from selling the call option on the TLT, and today we got back 16 cents. So it was a 20-cent loss, and our grand total P&L for the trading period was a negative 87-cent loss, and I'm not worried about it. We'll look at the macro view, and I continue to play the market very similar with the same big picture view. We'll look at the big picture view in a moment, but to get out of the trade, if you did take the previous trade, which we can look at, here was our previous trade alert. So you can see we sold to open the 147. Let me see if I can zoom in on that. This was last week's trade, and you can see how we sold to open the 147 call option, which means we get the credit to our account of $1.50 per share, or $150, and then we reinvested about half of that credit into downside protection. Last thing we need to do is outright own the most volatile bond instrument we can gain access to, the TLT, when this bond bubble finally pricks. So I do like to have underlying protection on the TLT, even though I believe it has much further to run higher. And we'll talk about why. Overall, we got a credit of 68 cents. So for every 100 shares of the TLT, we sold to open the August 23rd 147 call, and we bought to open the August 23rd 144.50 put. And this gave us a credit of 68 cents. Now we took part of that credit and we purchased a call option on NEM. Now today I've switched the ticker to a company that Stanley Druckenmiller owns. This one's primarily owned by the big mutual funds like BlackRock, Vanguard, all those guys. And my intention is to just simply rotate each week between NEM and the new ticker, GOLD. Now that's not the ETF, that's actually one of the bigger mining companies. So this was the play. We've been doing this play over and over again for this past month, and it's done very well for our portfolio. And we can see in this last trade, last week we had a $1.81 profit per share. In the week prior to that, we had $1.70 per share. Week prior to that, we had $1.09 per share. And the week prior to that, we had 58 cents a share. Now, today's trade alert is very similar, but I cannot reveal the actual trade alert in this live stream. So if you're getting this video after the bell, that means your free trial has expired. And it's time to call Dean and upgrade. This way you'll never miss out on a trade alert again because your free trial has expired. Now also, if you're a basic customer and you've paid for your annual membership, you get a 30-day trial to our Tuesday, Thursday play. Now, if your trial has expired, you're getting this again after the bell. So if you call Dean, you can get him at 505-322-7515. Upgrade your membership. We do have a special deal right now where you can get a lifetime membership and never pay an annual fee again. So people have been signing up for that left and right, and it's a great way to save money. Let's take a look at our overall strategy, how the portfolios are performing in total, and also look at some changes I've done to the precious metal portfolio. So I have gotten rid of the mining ETFs and in fact, I'll just showcase that. If we scroll to the bottom of the trailer, you can see kind of a little teaser of what we did today. But I do want to point out that we have adjusted our precious metals portfolio, and currently that is only holding a 75% position in GLD and a 25% position in BTC, that's Bitcoin. So Bitcoin I like to get from the Robinhood app, very easy, free transaction, and it's insured. And then GLD you can get at any brokerage. Now this is representing a total of 10% of our portfolio. And I've been adding and adding and adding to the precious metal buy and hold portfolio as the picture has become more clear that the U.S. Federal Reserve is going to have to lower interest rates and eventually starting to support the bond market. Now we're not there yet, and so this is most likely a 12 to 36 month rollout of lowering interest rates and slowly transitioning into buying up debt as this U.S.-China trade war starts to really become more and more important. So let's take a look now at our track record one more time. So you can see how I have my assets allocated. Currently, I'm a little lighter on the bond portfolio than the equities. So in total, I have 50% of my portfolio trading the Monday, Wednesday, Friday, plus Tuesday trades. Now, if you don't want to do the Tuesday trade, then you can just put it all into our SPY program, which trades the SPY ETF Monday, Wednesday, Friday. It takes advantage of 3 option expirations a week. And right now, I'm actually expecting both the stock market and the bond market to potentially rally into the remainder of the year, depending on trade war escalations. And so we'll look at the macro news in a moment. But it's important that people don't put all their eggs in one basket. If you notice, I always have a large equities portfolio position that's balanced with a large bond portfolio position. And I'm using a buy and hold strategy in the precious metals to get an extra edge in our total return. So this was up 200%. Then we added 25,000 to it to bring its total assets up to about 7.5. And today I just added another 50,000 to it, bringing its return down to 50%. So it was up 200%, but because we've been adding capital to this portfolio, it is showing a smaller return. Overall, we're up 15% in the past 9 months. So we're beating our goal of a safe 1% return a month. And we've only had one losing month if you do follow the complete program, and that was in July, a loss of 1%. All right, let's jump into the big picture view. And again, right now, the big the big news is that we have two really important things happening. Number one, the FOMC is having its next meeting and adjustment to interest rates September 18th, and they're meeting in Jackson Hole right now with Powell scheduled to have a speech this Friday. Now, the July minutes came out, and they weren't so dovish as people had hoped for, which may be the explanation for the volatility today and slight sell-off in equities and bonds. But those minutes were created before Trump had raised the tariffs. I think that now they are much more concerned about the recession globally and that they'll start to lower rates, perhaps 50 basis points at September 18th. And I think this is going to be very bullish for stocks and bonds in the U.S. markets. So we'll take a closer look at that, and this is the big view. Now, the caveat to all this is that we have two big issues. We have Hong Kong and Taiwan creating tensions with China beyond the tariffs. So China has vowed to retaliate on September 1st, as well as December 15th when these tariffs rise. Plus, they're upset about a huge military sale to Taiwan, and they believe we are putting our black hands into the Hong Kong protests. So I think if China were to aggressively retaliate, we'd see our bond portfolio take off to the upside, our precious metals portfolio take off to the upside, and our equities portfolio, we need to start betting down, which is fine and something we did in August to generate a nice return from the SPY program. That's one really nice thing about trading the SPY 3 times a week, is we can go with the trend of the market. Now, on the other hand, if the Chinese were to want to reduce tensions because things were getting too tough at home, they might consider buying agricultural products. If they did that, most likely the U.S. would reciprocate by lowering tariffs, easing up on Huawei, and I think we'd see a big push in equities prices and potentially a flattening or sell-off in the bonds and metals portfolio. So without knowing what's inside the head of Trump and President Xi, it's almost impossible to predict where to put the bulk of our capital. That's why it's important to have this balanced portfolio so that no matter what happens, we're really covered. We have the puts underneath all of our core assets. We're selling call options to generate consistent income, and you can see the results. It really works very well. So with that said, I'm going to go ahead and pull up my slideshow with the summary of our recommendations one last time, and then we'll jump into the big macro news. So again, per $100,000 you have to invest. Our current recommendation is to own 100 shares of the SPY and follow it with our Monday, Wednesday, Friday trade alert. And if you don't want to trade Facebook for whatever reason, you don't like Zuckerberg, you don't like all the government actions that are underway on Facebook, that's fine. You could just double up on the SPY trade. And to balance that out, you need 200 shares of the TLT. And we've recently simplified our buy and hold portfolio to just hold GLD and Bitcoin. I believe that GLD needs to travel up towards 175 a share from 140 before people will start thinking ahead to load up on the minor ETFs. And then on the other hand, with the altcoins, I think the same thing has to happen. I think Bitcoin needs to pop to its all-time high around 20K before we're going to finally see a lot of money start to flood into the alternatives to Bitcoin, such as Ethereum, Litecoin, Bitcoin Cash. And I also like the BNB coin at Binance. So that's essentially like the SPY ETF of cryptocurrencies. It's one coin that represents all of Binance's profits from the growth of blockchain. So that's our current recommendation. And again, we trade the SPY Monday, Wednesday, Friday at noon Eastern. We trade the individual stock, which is Facebook. Now on Tuesday, I might flip back and forth between the ETF SLV. I do believe silver is headed much higher, but I want to rotate into owning a specific equity that's had the worst sell-off and has the best monopoly. I like what Facebook's doing. They really do have a monopoly in the phone app space. They own just about every single top used phone app in the world. The only few they don't own would be primarily TikTok. So if you've even heard of that, they own everything else. They have an absolute monopoly. They're most likely going to have record-breaking profits in Q4, and they're actually creating a currency that does a better job at creating a store of value than I would argue gold or Bitcoin or the dollar can provide. So their Libra project is huge, and these are some of the reasons why I really like to be long Facebook in the current market environment, which is free money is floating everywhere. US still has strong earnings, and so I think the bull market is really intact for US equities without any major scares. Now, the market has become super sensitive to negative news, so that is again why we're not just all in on one asset class or the other. Now, a reminder, we have a paid member only webinar 1 p.m. Eastern with Zoom. It's where we can actually chat live. And then we have a freebie webinar today in about 30 minutes, which will have a replay sent out to everyone who's on the freebie list this weekend. So make sure to join our live webinars. We love to chat with you and get to know our members. And again, if you'd like to call Dean and upgrade to a lifetime membership, you'll get all our trades and never pay a fee. Again, that's 505-322-7515. Now, if you do have any specific support-related questions or trading questions, I would add this phone number as Portfolio Builder Support, 505-203-0396, and Victor is your go-to guy for that. Okay, let's look at the macro news today, and then we'll get ready for our live webinar. So in the morning, everything was up. We had some good data yesterday in America in terms of strong retail sales. And so we have a strong economy in the U.S. Plus, we have essentially the expectation for rates to go lower and lower. So this is helping fuel the corporate debt bubble, which is fueling their corporate buybacks. And we still have strong earnings. The government is creating a tremendous deficit, which helps goose up the GDP. So for now, without some sort of mass hysteria scare, it really looks like the bond market is stuck traveling slowly but surely higher. And U.S. equities could quickly become the only place to generate yield in the upcoming 12 to 24 months. So I am expecting potentially some big upside moves in equities. And again, this is all as long as the U.S. trade war doesn't heat up. Now, the problem is the U.S. trade war is almost certainly to heat up, so we have to play these markets carefully. There was something in the news today about the Fed potentially not lowering rates that pissed off all of the market, and that's why we're seeing a little sell-off in everything today. I don't think that'll really be the case, so we're not starting to bet down, as I think this is just a short-term sell-off. We have a speech from Jerome Friday, and then we have the FOMC meetings coming up in September. So we have some pretty big catalysts to keep this bubble expanding, and the only real fear I have is what exactly will China do to retaliate. I don't think they're going to do much, but we will see, and that will help us dictate how bullish to be on the bonds and gold, and whether we need to become bearish on our SPY position. And again, we don't mind trading the SPY to the downside. Our option strategy can make that extremely lucrative, but the big picture is not lining up for that yet. We need some sort of catalyst to spark some fear before I think we'll see any considerable sell-off in equities. So here's the TLT. This is our core position for the Thursday trade, and it's at all-time highs over the last 9 years. And I suspect it can go considerably higher when we look at the relative interest rates around the world, especially Germany. And so here's a 3-month view, a little sell-off. Here's that 10-year view of LQD. This is the corporate investment grade debt. This has some big borrowers like General Electric and AT&T that are concerning. And I would suspect that if this ETF were to sell off, that would potentially mark trouble for the U.S. equity market, because this would mean that the big companies that have been pushing the SPY higher and higher could potentially start having to pay higher interest rates to borrow money, which means they may do less corporate buybacks, and that's what's been really pushing equities higher. So this is an important investment grade bond ETF that we pay close attention to. You can see it's been on quite a roar to the upside. Now the concern is that some of this bond portfolio could get re-rated and thrown into this ETF, HYG, which is not doing nearly as well as LQD, and definitely shows that at least the middle of American companies are still struggling, and we can see that also with the Russell 2000. Here's a look at GLD. Just to get back to the 2012 run up, we need to get to 184. So I'm looking for GLD to push up towards 175 before I'll probably take some profits out of GLD, which is spot price gold, and start looking at those mining ETFs. So I am trying to keep our buy and hold and our total strategy as simple as possible with as few securities as possible, so that number one, you have less charts to check each day. Number two, you're not going to get confused. And number three, you really simplify your investment strategy and can get better results by not having too many pots on the fire. Here's a look at gold. This is the stock that we bought a call option on today. Stanley Druckenmiller has a position in this. And the other big one is NEM. My intentions on the Thursday play is to rotate back and forth between these two stocks. Right now, GLD has done much better than NEM, but they both have major backers behind them. And so for now, we're playing that with call options. And you can see gold ticker just going absolutely nuts over the last 2 months with almost 100% return. Now this is fascinating. Of all the downside today, the only ticker I've really seen up is Deutsche Bank. And so there's been rumors of a lot of stimulus in Germany. They've had a bounce in their yield, and perhaps that's a positive sign for the banking in Germany. A lot of drama surrounding Deutsche Bank, and certainly a potentially systematic problem for the entire financial system if this bank were to go insolvent. China getting pounded today, and this is the most alarming data in today that does make me question whether we should be long the SPY yet. There is a potential for a nice sell-off with the expected retaliations ahead from China. And so our big bullish event for the SPY is really not potentially until mid-September, September 18th to be specific. So I'm carefully watching this to see, is the market going to front run the Fed expectations and run up the SPY to new highs, or is it going to try to create some sort of panic and then run it up right before the event? Either way, I'm quite confident the SPY is traveling significantly higher unless we get some major aggressiveness from the Chinese, which I don't think is their intentions. Now, these big losses in these different products today are definitely alarming. And we'll look at one other very alarming chart next. Now, on our Tuesday play, we've been actually buying put options on FXI. We were able to get out of half of those for a 90% return last week during the middle of the sell-off, and we're still holding on to some September expiration puts on FXI. I do think that the more the trade war escalates, that FXI could potentially crash at a faster pace than the U.S. equity market. So we're playing that in our Tuesday trade alert. We didn't do it this week because I am expecting a general push higher in equity prices as long as there's no escalation. Now, we will look at a chart in a minute that is very concerning. EWY is the South Korean ETF. As you can see, it's not showing strength. IWM, the Russell 2000 composite, struggling to get anywhere near highs. So this is also showing some weakness in the U.S. equities. Crude oil showing weakness in growth, but of course we are seeing a little bit of a bounce. And here's the most alarming chart to be concerned about. We have the conversion rate of the won to the US dollar getting back to that 7.1 level. This is again the main tool, perhaps the only tool the Chinese really have to cause drama with the US, and that's to devalue their currency. That offsets the tariffs, because now you can convert your dollar and get a couple extra, about 10% extra won, and this essentially makes the tariffs not really work. Now on the other side, for people who've saved money in China, this is devastating. Their savings are losing value, and it's creating lots of inflation with average goods like food, and so that's the core reason we like to own things like gold and Bitcoin right now, is because of the weakness in the Chinese currency and the weakness in the euro, and especially in the weakness in most emerging market currencies. People are trying to get out of their own currencies and buy something that can store value better, which also plays into why we like Facebook and its Libra project, as that may do a better job of doing that than anything else to date. Here's the 5-year view, so you can see that we are at all-time lows in terms of the value of the won against the dollar. Euro is devaluing, and so all of this continues to push capital into U.S. markets, from the dollar to the bond market to the equities market. This is the best leading indicator of what will happen to U.S. Treasuries, and if you look at the big picture, you can see it's literally in free fall. You're now paying the German government to borrow them money. It's complete insanity. People are doing this simply because they want to flip their bonds. And as long as the data continues to show a recession underway, these can go lower and lower until everyone freaks out and decides to sell it. That's when the central banks will have to support their yields to avoid a complete collapse of their bond market. And that, my friends, is when we want to own our gold and our Bitcoin, because the money supply will greatly be increased and potentially push those positions much higher. So here you can see that little bounce in the yield, which is quite likely why we saw the first loss in the last 5 trading periods on the TLT. Trump is here talking about how the economy is doing really well, but we need to lower rates. Upset that America has to pay for debt while Germany gets paid. On the other hand, if we didn't have some sort of yield, we'd probably have a lot less demand for our bonds. So perhaps you got to be careful what you wish for. Manufacturing PMI unexpectedly crashes into contraction with the lowest print in 10 years. So this should help with the outlook that the Fed does need to lower rates, which should be bullish for bonds and equities, because we're not seeing any sort of problems in the earnings yet. Microsoft just had a record quarter. Apple came out with a nice quarter. Amazon was a little sluggish, but overall the big leaders of the SPY that have been dragging it higher and higher are doing well. All the while we're seeing the average Joe companies, the Russell 2000, struggling to get to new highs, even to really rebound. We keep seeing the 2s and 10s yield invert, which essentially signaling a potential recession. This was the interview that caused some sort of sell-off today. Fed's Harker, who's not a voting member, thinks that the central bank should just stay at the current rate level. And I think if they do that, we're in for a serious sell-off in just about everything. Just think of 2018. Every single asset class had a negative return. Maybe it's smart. Maybe it would be good in the long run to help weed out all the poor investments that are going on. But in terms of us trying to predict the markets, I don't think this is accurate. Otherwise, we would be flipping our option callers to profit from both the TLT and SPY traveling lower. Some info about the yield curve. Trump just going off about how Germany gets to be paid to borrow money and the U.S. has to compete with them. But on the other hand, if you think about it, what would you rather do? Get paid 1.5% on a 10-year U.S. bond, or would you rather pay Germany, 0.7% a year for the right to borrow the money? It's complete insanity, and I think that's definitely a worrisome sign that this even exists. It's one of the first times in history that we've had so much negative yielding debt, and the markets are now working in the exact opposite way they should. Okay, some updates from China. So we are seeing their currency go back to that 7.1 level. The rumor is that the HSBC Bank, a huge European bank, was helping them support their currency. And now that deal has been broken. And so the question is, can China really afford to maintain their current relatively decent conversion rate of 7.1 to the dollar? And if they are running out of dollars, which we do think they are, they may not be able to support that. So if that were to blow up and go to 8 or 9, we could have a real mess in our hands. Massive currency devaluations around the world, the dollar rocketing up, and this can cause all kinds of problems with trade. Chinese Commerce Ministry, President Trump has said Hong Kong is part of China and not necessary for the U.S. to intervene. Hopes the U.S. can stick to its word. Chinese Commerce Ministry, China and U.S. trade teams have kept in touch. No news, So the big news I'm looking for is either one, they do something to retaliate this latest round of tariffs, or two, they start buying farm goods. If they start buying agricultural products, I would suspect Trump will give Huawei some sort of relief and potentially just leave the old tariffs on and not implement these new tariffs. So a very careful thing to watch. It would seem like it's so simple, but depending on where we go from there, can make a dramatic difference in how we want to play these markets. Now, if it just kind of stays how it is with a little tit-for-tat bickering back and forth, I think we'll see that the stocks and bonds in the U.S. continue to climb, the dollar remains strong, and emerging markets continue to suffer and push their bond yields lower and lower and lower. So we'll see how it plays out here, and we know what to do depending on what happens. Some more tweets. Now again, in the document, in the description box below the YouTube video, there's a link to my live stream doc, so you can go through all these charts. And also at the very bottom, I have a few YouTube videos I recommend each day. A little humor. So it used to be President Xi and Obama with Tigger and Winnie the Pooh. And now we have Carrie Lam from Hong Kong with President Xi as the new. China had actually banned photos of Winnie the Pooh for a period of time when that was being circulated. And of course, they censor their internet, their text messages, very controlled society. And so the big thing in Hong Kong is they just want her to remove the extradition bill, release all the people who've been imprisoned from the Hong Kong protests. They have 5 demands, but those are the big 2, and they will not do it. Of course, Carrie Lam can't. She's under the control of the CCP, the Communist China Party. And so there's a little comedy for you. Key takeaways from the Fed minutes. Now again, this was before Trump came out with the surprise tariffs in August, so I think they're relatively moderate views of being hawkish or dovish will become much more dovish by September as this is a huge escalation in the trade war, which we already got through. We were short the SPY most of August, called the bottom. I've been making good profits to the upside. I'm still bullish on equities outside of the Chinese retaliating. We already know what's in the cards for the U.S., so we'll see how big of a defense China puts up against this. Here was the key takeaways from the long view, who used to work for Ray Dalio. Fed is going to be way more dovish in 2020 with new voting members. Bullard is a liar or has a muzzle. Fed is struggling with global versus U.S. growth divergence, which is again why we like to be long the U.S. currently and then buy those puts on FXI, the Chinese large cap. And data developments between meetings matter and influence decisions. So we have a big change in the tariffs from July to August. Fed minutes hint at coming QE, so we may be quite a ways from there. But we do expect they will continue to mention that. And also the ECB is getting ready for a bazooka of stimulus. So that is also expected. And that's why I want to be long the equities and the bonds in the U.S. During what I think could quickly become one of the biggest bubbles of all time. Not that it already isn't, but I think people are underestimating how big this can get before it all comes blowing up on itself. And so just tweet after tweet after tweet after tweet from Trump to lower rates, print money, and help him finance a gigantic deficit. We'll see how much trouble the Democrats give Trump. Will they let him get an infrastructure bill in to go blow $1 trillion to improve America's infrastructure? If so, that could be huge to the GDP. Put that on top of everybody trying to front run all the tariffs. That's also helping push our GDP numbers up. No one seems to give a rat's ass about the $22 trillion in debt America has. And now that the rates are getting lower and lower, what better time to refinance all your old debt and take on new debt when you can get it for almost free? So that's kind of the outlook. What's going to end the party will most likely be runaway inflation. Until we get inflation on the metrics that the Fed pays attention to, I think this bubble continues to get out of control and grow. Now also, what's China's intent? Are they going to try to get Trump out of office? Perhaps. Perhaps that is their single most important goal, and they can do this in a number of ways. They're not going to try to do it with kinetic fighting. Really, with information wars and economic wars are really their only chance. So it's exciting. There's a lot of drama unfolding. And let's see what YouTube videos I have for you below. This is with Kyle Bass and Steve Bannon. Excellent interview. Goes over really what the point of view of the Chinese is and what they expect them to do during this trade war. Trump's infamous now, I am the chosen one to take on China interview. Good interview. Clearly shows he's not going to back down on this, so he does want a deal. We'll see what kind of deal he gets, if any. Here's a new Macro Voice interview. She's been a little bit she's smart, and her dad has advised many different presidents. She's very optimistic about everything, and so if you want a bullish point of view, here's a good interview. I like all of Macro Voice's interviews. Take it with a grain of salt. Here's a lady named Whitney Webb. She's been interviewed all over the place about this Epstein deal. He essentially was saying that he has dirt on CEOs of tech companies that he would give up in exchange for a maximum 5-year sentence. And then he was mysteriously found as a suicide. He has a lot of connections to potentially to Mossad, to the CIA, to the Clintons, and even to Attorney General Barr, at least his father. So if you want to go down the rabbit hole, that's an interesting interview. Really not the connections to Trump as much, just kind of swimming in the same pools of people in New York. Here's a good interview from Recession Watch with Real Vision. They're very doom and gloomy in general. They sell some sort of advisory products. At the end of the day, they're just long gold, long bonds, long Bitcoin. So we've already got those bases covered with our strategy, but they're worried about China collapsing the whole economic system with all their debt. So that's a wrap for today's Trade Alert video. Hope you guys enjoyed it. Please make sure you like and comment on our video. That helps with our organic rankings. And look for a new Trade Alert tomorrow at noon Eastern. Thanks.